Right now, for a look at the Fed's rate path ahead of this morning's inflation data and next week's central bank meeting, we want to bring in Krishna Guha, Evercore ISI vice chairman, who heads the global policy and central bank strategy team. And Krishna, thanks for being here this morning. We've got this PCI number coming up. Between that and what we heard yesterday with some weaker than expected jobs numbers and weaker than expected, or jobless claims numbers, I should say, and weaker than expected GDP, what does this all add up to for the Fed?
Well, it certainly wasn't a great set of releases yesterday for the Fed, but I think that they'll be overwhelmingly focused on the inflation data. The growth stuff was weak at the headline level, but pretty solid underlying, with a little cooling in consumption at the margin. That's sort of what the Fed would like to see. But the inflation data is what the Fed does not want to see. So what we learned yesterday was that in the first quarter of this year, taken together, inflation was even hotter than we had previously understood. And we'll understand that a bit better when we get the monthly PCE report for March today. But it certainly confirms that things went the wrong way for the Fed in the first quarter.
Yeah, the two-year yield is reflecting that this morning, above 5% again. Where do you think rates are headed?
So, look, I still think right now that the single most likely outcome is that the Fed is able to cut rates in either July or September and get another one done by the end of the year. But that's hanging by a thread. At this point, the Fed simply can't move forward until and unless they get a step down in the monthly pace of inflation that holds over at least, say, 2-3 months, so they can see a new trend emerging that's pointing back down towards 2%. So think maybe 3 inflation prints in a row with that month-over-month core PCE that they watch so carefully around 0.2, 0, at least the very low 0.2s. Until and unless that happens, they're stuck.
So that's your expectation for what's going to happen today? If you think a rate cut is likely, you do think the PCE is going to come in at that level today?
So not today, because we already basically know what today's number is. It's going to be around 0.3. So why do we know that? Because this is March, right? And they've already given us January, February, and March together. So we can just subtract out some level for January and February and infer March. Now, we're going to learn today the distribution across January, February, and March. We're going to learn the composition of the inflation in March. All this matters. But the basic idea that March is going to print too high, we know that already. That's already in the price. The question is, do we step lower April, May, June, which is what we need to get going on rate cuts in July, or do we not? If that's not, we slip to September. That's a difficult meeting. It can go, but it's a difficult meeting right against the election and with bad base effects. And more broadly, if the inflation does not step down over the months ahead, the Fed will at some point have to make a deeper, more fundamental reassessment of the inflation dynamics in the U.S., how much work they've done and how much they need to do going forward. They will hope to deliver whatever is needed by staying where they are for longer. I don't think anyone inside the Fed yet is actively considering the possibility of rate hikes in the way the market discussion is. But at some horizon, far enough into next year, if you're not seeing what you want, in particular, if inflation were to accelerate back up again above 3, say 3.25, that's when rate hikes could come back on the table. Not now, possibly later.
Krishna, at the risk of kicking back up a conversation that just died down around the table, what do you think of the Wall Street Journal story that says advisors close to Trump would like to draw up plans to rein in the Fed's independence, the idea of making a mandatory litmus test that any candidate for Fed chairman would have to agree to consult with President Trump before making any changes to interest rates and beyond?
I think that would be a seriously bad idea. And I think if anyone tried to move forward with that, the bond market and the stock market would make it very clear what a bad idea that was. Now, I think what I hope that former President Trump will understand, what I hope his more sophisticated advisors will tell him, is having an independent Fed would help you achieve your goals. Having an independent Fed has credibility. That means bond yields are lower. It means the cost of funds for your government is lower. It means the market and investors have more confidence, which means the stock market is higher. That's a gift for any president. It would be a gift for President Trump. And you would be insane to hurt yourself and your own administration by undermining Fed independence.